Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are going to be analyzing two articles, to where the first one is titled, Palantir, I'm Going All In. And then after that, we're going to be analyzing another article about SOFI Technologies named, This One Meme Stock Has Legitimate Long-Term Upside. So clearly we're going to be going over their latest news updates, upcoming catalysts, price targets, and where we could see Palantir Technologies as well as SOFI Technologies go in the future in regards to their share price. So for more videos on either Palantir Technologies or SOFI Technologies, don't forget to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, don't forget to become a member of this channel for as little as 99 cents per month because that's what keeps me here on YouTube. And with that being said, I say let's jump right into today's stories. We're going to start off analyzing the article titled Palantir, I'm Going All In. And let me tell you, do not go all in on one singular risky growth company. That is extremely improper risk management by going all in for any company. I can't believe that there are financial reporters that would name their article this or even advocate for investors to do this. You always want to practice proper risk management so you can build wealth at a stable, safe pace. That's why we have the risk management policy of not investing more than a 5% initial portfolio allocation into any singular risky growth company, and that would include Palantir Technologies. And I normally give the example to where if your portfolio value is $100,000 and you want to invest into Palantir Technologies, you are able to invest $5,000 or up to $5,000 into Palantir. You can do that either in a lump sum amount, meaning all at once or within the same week, or you could dollar cost average, which is what I normally do, meaning you're going to spread that $5,000 over the course of many weeks or even months. And this gives you an average cost basis that is rather competitive, which will be determined by your average investing price for the stock. However, even if Palantir ends up growing above a 5% initial portfolio allocation, that's okay. It can grow above that and make up 10% of your portfolio, but just know that if you invested $5,000, then you need to let the company ride for the long term, and you can take profits here and there and reinvest as you will, but the main point is that you don't want to overexpose yourself to just one singular company. You want to have multiple phenomenal companies in your portfolio, which is what makes you diversified, safe, resilient, and it actually makes you more money. Because while other companies in your portfolio may be falling, your other investments may be rising, thus offsetting any losses and still bringing you in profits. So I am extremely against going all in into any singular stock, especially Palantir Technologies, because it's so volatile. But with that being said, I do love Palantir Technologies and I personally hold it in my portfolio. Palantir Technologies, if you didn't know, is a big data and analytics company which serves both commercial enterprises as well as government clients, and they specialize in artificial intelligence as well as machine learning. Right now, their PLTR share price trades at $19.60 per share, while very bullish investors believe this company could surge up to $25 over the next 12 months. And I believe that this company could definitely be worth higher than it is right now. However, a pullback is imminent for this company, and I'll tell you why in just a moment. But first, let's address this very overly bullish article. Now, again, I love the enthusiasm about people that are so confident that they're willing to invest and go all in for Palantir to make up 100% of their portfolio, but let me tell you, that is improper risk management. You're taking on the risk of unnecessary losses, and it's just not worth the risk. It's far better to have some exposure to Palantir, as well as other phenomenal stocks like Alphabet, Amazon, Apple, Microsoft, Berkshire Hathaway, and a lot of other companies like that. However, let's dive into why this author is so bullish on Palantir Technologies. As you know, their PLTR stock has surged in recent weeks, which was mainly due to their amazing Q3 results and their phenomenal Q4 guidance, which got the market very excited about the growth prospects of this company. I personally still believe that their business will experience a lot of growth throughout the remainder of this year, well into next year, even though Palantir trades at very high accounting multiples, which means they are trading at a more expensive valuation than the average multiples for their particular segment, and this is not good news. Ideally, we would want Palantir's multiples to be below their market averages regarding the market multiples. That way, we can guarantee that we are getting a good price on this stock. If you are investing into this company right now, you are investing at a very high share price, which is moving your average cost basis upwards, which is not going to benefit you for the long term. Because in a perfect world, we want to get this company as cheap as possible, and Palantir will give us that opportunity once they pull back. Palantir so far has had amazing performance, and that performance has helped their overall stock price appreciate to a new 52-week high. And there are multiple reasons for this, and there are even more reasons to believe that shares could go even higher based off of their current momentum. But again, with that being said, we have yet to experience a major pullback, which will come. It is not a matter of if it will come, it's a matter of when it will come. And once it does come, which will be inevitable, that would be the best buying opportunity. So right now, it's better just to hold and watch your portfolio value go up as Palantir continues to appreciate upwards, and then once it pulls back, you buy on weakness. That is how you invest. Now, I do want to go over why I really like this company, but again, we are practicing proper risk management here, and it does not make up more than a 5% initial portfolio allocation. Also, I've mentioned this in the new year, I will actually show you all my YouTube portfolio, and we will see how it consistently gains profits and makes me money month over month and week over week. So remember to comment down below if you want to see my personal YouTube portfolio, and keep in mind that I had 5 portfolios. I have sold off 2 of those portfolios completely, and then I have 1 portfolio for YouTube and 2 different retirement portfolios, and you all will be looking at the YouTube portfolio. But now let's go back to Palantir. Palantir has received a lot of optimism from investors due to their artificial intelligence platform known as AIP, and that came into existence earlier this year, where Palantir was able to generate an impressive interest for this platform, which attracted 300 major clients, and the majority of these clients are from the S&P 500, meaning the largest 500 companies within the United States. We also know that artificial intelligence is a huge buzzword right now, and Palantir is also receiving a lot of accolades from their help regarding warfare over in Ukraine as well as Israel. Palantir is currently using their platforms on the battlefield by helping Ukraine fight against Russia, and they also have a very good network and relationship with Israel, and they will be helping Israel fight against Hamas. We even heard Ukraine's Minister of Digital Transformation reveal that Palantir's AIP platform is being used as one of the primary generative AI tools to help the government learn about how many mined areas there currently are and how long it will take to demine them. And a mine essentially here is if you step on it, you blow up. So clearly we don't want a lot of those around. And the minister notes that this originally would take their analysts multiple days, which could put people at risk of getting blown up by these mines. However, thanks to Palantir's AIP platform, it only took mere moments to discover these mines, meaning that this is very beneficial to have on the battlefield because it's saving lives. Speaking of which, at the same time, this same software is being used by their commercial sector, to where their artificial intelligence tools are helping organizations better optimize their own everyday tasks, which is saving the company money, and it's also optimizing their overall effectiveness and efficiencies. The company is now on track to conduct AIP boot camps for over 140 organizations, and this is where Palantir teaches other organizations how to properly use their artificial intelligence platform, which to me is a phenomenal selling technique. So given all of these phenomenal growth opportunities, there's really no denying Palantir's amazing future in business, and considering that they virtually have no debt and a war chest worth of cash on hand of over $3 billion, plus aggressive double-digit returns in revenue growth, this is amazing. We also have to remember that they are GAAP profitable, so this company clearly is going to scale aggressively in the future. However, as of right now, their accounting ratios and multiples are too high, and that's why we are waiting for a pullback. Now, we also saw a recent DCF model, which is a discounted cash flow model, say that Palantir's fair value is actually $16.05 per share, and this is phenomenal. Originally, Palantir was pegged at a fair value price of $11, then that got moved up to $13 by Morningstar, and then this author believes that their fair value is actually $16.05. So ideally, we would want to wait for Palantir to pull back below their fair value price before purchasing more shares. And that is how you make long-term gains for companies like Palantir. Therefore, this just goes to show that Palantir Palantir is looking to become one of the most important companies in the artificial intelligence space, and we could more than justify their current valuation based upon their future growth. However, it's not that simple. When we look over at Seeking Alpha's quant system, we see that Palantir has a grade of D- for their valuation, and that's exactly what we are saying. We are saying that they are trading too high to offset their growth valuation and their multiples. Therefore, waiting for a pullback right now is the best thing to do. Meanwhile, their other metrics score as a B+ or higher, which is very positive. So if their overall share price could just come down below their fair value and then we purchase their shares, then Palantir would be over a B rating in all regards, making this a phenomenal company to hold for the long term. Like we said earlier, the most bullish Wall Street projection right now by a 5-star analyst is around $25 per share. So clearly there is a lot of momentum behind this stock, but I don't want investors to get caught up in this FOMO of Palantir surging. Yes, it could go even higher than it is right now, and it most certainly could surge up to $25 over the next few months or over the next year. However, as a wise investor, you would only want to invest into this company when it pulls back in their share price, because that guarantees that you are getting a good price. We also have a huge catalyst coming forward for them potentially signing new contracts with the NHS and their upcoming inclusion into the S&P 500, which is phenomenal. So these are the reasons why I personally own Palantir Technologies. But again, do not pay attention to the title of this article where somebody is not practicing proper risk management and they are going all in on this company, and I completely reject that. That is not being a good investor, that's not being a wise investor, and over the long term, that strategy just does not pay out. It's far too risky. Essentially, with that mentality, you might as well go to a casino because you are gambling at that point and not investing. But I would love to hear your thoughts down below about that. Up next, now let's talk about SOFI Technologies, ticker symbol SOFI. SOFI Technologies, as you probably already know, is a fintech company or a financial technology company that essentially operates as a digital bank, and many people refer to this company as a meme stock. And that means they are putting it in the same category as AMC Entertainment and GameStop. However, to me, SOFI is not a meme stock at all. Their business is far too resilient to be called a meme stock, and I think this financial technology company has large amounts of upside. And here's what I mean by that. SOFI Technologies is a digital bank, and you can get a plethora of financial services and products all from your smartphone through their official app. And that means they have no brick and mortar branches or stores, unlike other banks such as JP Morgan Chase, Bank of America, and Capital One, just to name a few. That means JP Morgan, Bank of America, and Capital One are spending loads of money on physical branches, meaning that they could potentially be paying rent, they're paying taxes on these buildings, and there is upkeep, you gotta pay for electricity, water, and many other expenses. However, SOFI doesn't have these expenses because they operate digitally. So unsurprisingly, this digital-first approach is attracting a lot of young high earners with FICO scores above 744, which is very strong, and these young high earners even make over $100,000, with the majority of them making around $167,000 or more. Currently, SOFI stock trades at $6.94 per share, while very bullish investors believe this company could surge up to $12 or $15 over the next 12 months. And this is unsurprising due to their very strong performance. SOFI Technologies has been a tremendous growth story so far, to where in the most recent quarter, their revenue and members increased by 27% and 47% respectively, meaning this company is on a fantastic growth trajectory. Another thing to note is that they survived the regional banking crisis when a multitude of financial institutions ended up collapsing. And SOFI not only survived, but they thrived because they got to steal market away from these other failing financial institutions. And that just goes to show how strong and resilient this company truly is. For instance, we saw their deposits absolutely explode, which means more people are not only becoming members, but putting their money into SOFI. As of the end of 2022, SOFI had around $7.3 billion worth of deposits, which skyrocketed up to $15.7 billion as of September 30th, which is a huge increase. However, on the negative side, we saw SOFI post a net loss of $267 million, which was significantly higher than the loss that they post a year ago, to where they only had a net loss of $74 million. But don't be led astray here. The reason why their net losses surged was because of a one-time non-cash impairment of goodwill. So essentially, this is not going to be an ongoing loss, and SOFI is doing so well that management predicts SOFI will become GAAP profitable in the current quarter we are in right now. And once they become profitable, not only does has this company become a better buying opportunity, but also a much safer investment overall. So if you've already bought into this company and your average cost basis is below $5 to $6, then you are doing very good right now, especially considering that SoFi shares have outperformed the major indexes, because SoFi stock has surged by around 46% in their share price, while the NASDAQ Composite Index surged by around 30%. So this company was a phenomenal investment year to date. We also know that they still remain 74% below their all-time high, meaning that this company will eventually reach that in the future according to their current growth projections. They are also trading at a very welcoming PS multiple, or price to sales multiple, of 3.2, and that means their PS ratio is much more attractive than other companies like Palantir Technologies as an example. So not only does SoFi Technologies have very good multiples, but they are also on the verge of profitability. In the end, both Palantir and SoFi are very strong, risky, long-term investments. You would want to get these companies as cheap as possible, meaning that you should buy on pullbacks, and you should always practice proper risk management and not overexpose yourself to any singular risky growth company. However, this rule of thumb is only applicable to singular stocks. If you were to invest into mutual funds, index funds, or ETFs, such as VOO, VTI, SCHD, QQQM, MTUM, and others like that, feel free to invest literally as much as you want, because those are so diversified and so good that this risk management policy doesn't apply, because you are already meeting your diversification needs. With that being said, I would love to hear your thoughts down below in the comments about either of these companies. Subscribe if you are new. Don't forget to become a member of this channel for as little as 99 cents per month, because that's what keeps me here on YouTube. And with all of that being said, I wish you the best of luck, happy investing, and I will see you in the next YT video.